Good morning, everybody. Happy Friday. It's August 2nd. Grain markets are mixed this morning. Brian Split is with us. Guys, let's start off with this StoneX crop survey.
Well-followed private group StoneX released U.S. crop estimates yesterday. Based on a customer survey, the group pegged the national average corn yield at 182.3 bushels per acre compared to USDA's most recent estimate of 181 bushels per acre. The crop was seen at 15.2 billion bushels versus USDA's most recent estimate of 15.1 billion bushels. The national soybean yield was seen at 52.6 bushels per acre versus USDA's most recent estimate of 52 bushels per acre. The crop was seen at 4.48 billion versus USDA's most recent estimate of 4.43 billion.
To look at the state-by-state breakdown here, you got some pretty solid corn yields estimated across your heart of the Corn Belt areas. Illinois at 210, Iowa at 210, Indiana at 205. You go up north and it gets a little worse. Wisconsin 170, Minnesota 185. Brian, 182.3 and 52.6, fair or foul?
I think it's fair right now. I think there's definitely a shot of above trend yield, and these would be new record yields by almost 5 bushels per acre. The USDA, I think, is over the last 25 years, they have changed corn yield 25 of those years, every single year from July to August. So we're going to have some type of a yield adjustment from the USDA. It's just a matter of whether the trade is right in that yield going up. I think it is, just based on everything I've heard talking about the crops from clients in different areas. And granted, there's some trouble spots, but I think there's some really, really good corn out there.
Correct me if I'm wrong, and I forget things sometimes, but I think USDA was actually supposed to start, like if they stuck with their old trend, would have been like a 182 and change type yield, but they went down to a 181 to start because we've kind of underperformed the trend, or we've kind of stagnated here the last few years. So yeah, if that's real, that 182 3, I mean, yeah, record above trend. Same thing with soybeans. If you get up to 52.6, it seems very possible. I mean, everything we know about crop ratings, and I understand crop ratings aren't perfect, but that would lead you to believe that we'd be above trend. A lot of the weather, rainfall patterns and totals and things like that would lead you to believe that we're above trend. Is that a guarantee of anything? No. And this is one look at the yield numbers. There's going to be a lot more of these as we move on here.
U.S. corn export sales were poor last week. Net corn sales fell below pre-report expectations and notched a marketing year low at 7 million bushels. The print was down 49% from the previous week and down 60% from the prior 4-week average. Mexico was the largest corn buyer for the week. Net soybean sales exceeded pre-report expectations at 14 million bushels. The print was up significantly from the previous week and from the prior 4-week average. Germany was the largest buyer for the week. Net wheat sales were near the lower end of expectations at 11 million bushels. The print was down 7% from the previous week and down 41% from the prior 4-week average. And Indonesia was the largest wheat buyer for the week.
Old crop sales of corn and soybeans, I don't have any issue with. We're going to hit the targets within a margin. To look at new crop sales, we're finally above, in terms of soybean commitments, we're finally above 2019, which was your big trade war year. So golf clap for that, I guess. Here's a statistic for you. Chinese commitments of new crop U.S. soybeans, what they've booked so far, 162,000 metric tons. It doesn't include yesterday's flash sale. The prior 3-year average is 5.3. So new crop Chinese purchases of U.S. soybeans are down 97% from the prior 3-year average. They basically bought next to nothing, essentially. Corn sales are slightly better in context, but still the 5th worst of the last 10 years and closer to the lower end of the range. Still got demand problems, Brian.
We do have demand problems, and there's the context of overall demand from China, and then demand specifically for U.S. product, and when we're talking about soybeans. And we're really just seeing that long tail of this Brazilian crop that we had, and even though it wasn't as big as the potential could have been if they had a trend yield there. Remember, we had quite a few issues up north in Mato Grosso that significantly impacted yields, but it was still a large crop nonetheless, and so that gives them an awful lot of product to sell. So there's the issue of buying Brazil instead of U.S. and how long that will last, and eventually they'll need to come to the U.S. a little bit more in earnest. to fill that gap between wherever they are and the new crop soybean out of Brazil, which could be as big as 170 plus million tons for the crop upcoming. But then there's the issue of the USDA's estimates of how much the Chinese are going to import total, and it's 8-9 million tons larger than kind of their upper end of what they have imported over the last several years. So I don't know if the exercise of increasing demand just because there's extra production out there is going to be a good assumption for the USDA this year for Chinese soybean imports.
Could you make the argument that demand and export demand for soybeans in particular is a bigger problem than the big crop we're going to have in the United States?
It is, yes, but that's something that can change pretty quickly. All it requires is China coming in and going on a buying spree. But to your point, when you think about how much we've typically already seen as far as sales for the new crop as we get leading up into the marketing year, we've typically already seen several million tons of beans purchased ahead of time.
Yep.
So the fact that we've got 2 boatloads on the books, not including yesterday. Man, that is extremely concerning. Now, the glass half full person would say, well, because they're so far behind, that means that there's all this buying that's in front of us to an extent, but we got to see that kick in, and how long does it last? Again, because there's a tighter period of time between now and when the Brazilian crop will be online again, and that's less than 6 months away. We're talking 4 or 5 months until that crop is already here.
You could paint a lot of different scenarios. Like, China could come in and buy a bunch of beans from the US now. And if Brazil ends up with 170 million metric ton crop, they could cancel a whole bunch of them down the road. There's a lot of different scenarios that could play out here. We did have a flash sale yesterday.
We sure did. U.S. exporters sold 5 million bushels of soybeans to China for delivery during the next marketing year. Year to date, China has only made 2 flash sales of soybeans for the next marketing year, totaling 10 million bushels.
At risk of being Debbie Downer this morning, I'm going to say this is bad news because it's so small and just routine. And yeah, does it increase the book a little bit? But yeah, but this is not going to get anybody excited. And I think people are going to look at this and be like, they're just buying the bare minimum.
Right. So this 132,000 total, that's 2 boatloads. Okay. And so when you think back to previous years, especially, I just anecdotally kind of remember August being a month where Chinese buying has picked up quite a bit.
Yeah.
But what we have to watch out for is when we start getting these sales where it's like 400,000, 600,000 bushels at a time.
What we need.
That is when China is in an actual strong buying program. If we start seeing that, we're going to have some short covering from the funds, but 2 boatloads isn't going to do that.
No.
The weekly drought monitor was released yesterday. Rainfall was limited across the Corn Belt last week, and because of this, drought conditions worsened in western and southwest Missouri, northern Wisconsin, eastern Indiana, southeast Ohio, and northeast Kentucky. Much like the Corn Belt, precipitation across the High Plains was also limited. Drought conditions worsened in northeast and southeast Nebraska, northeast Oklahoma, and throughout Kansas. When we look at the percentage of U.S. areas experiencing drought, corn country 5%, soybeans also 5%, winter wheat 32%, spring wheat 16%, and cattle country 15%.
Again, drought still persists in far eastern areas that do grow corn, but they're not big needle movers like, Illinois or Iowa would be. But there are some problems out east. You go into Pennsylvania, you go into parts of Ohio, into Carolinas, Virginia, whatever. And then you go southwest. Kansas has some drought problems. Over the last 7 days, there's been a lot of rain. I mean, it's never perfect. It never covers everywhere, but it's been fairly substantial. Is there any weather issue that you see right now, Brian?
From a pure moisture precip perspective and temperature perspective, no. I know we've got some high temperatures right now, and those are going to be wrapping up as we get out of the weekend. But when I look at what we had during the month of July as far as precip and temperatures, those 2 things combined, and really it's the precip in July that has the highest weighted influence, and then the temperatures after that. Those are the 2 things that have the highest impact on corn yield. And so I think both of those should be seen as very supportive to an increase in corn yield during the month of July. And then when we look at what's coming ahead, I mean, shoot, for us, and again, we're in the northwest suburbs of Chicago, but we're looking at temperatures really that are going to be in the 70s to low 80s all the way into mid-August. We've got shots of rain throughout, so there's really nothing threatening on the forecast currently. So if something pops up, it's going to be towards the back end of the models as we get into mid to late August, or if we have some kind of storms that are just really strong and have that derecho effect. And we saw, in 2020 that did have an impact on the market. But until we get something like that, the forecast that I see right now just isn't going to be majorly supportive to a rally in grains.
It's getting too late. It's getting too late for a crop scare event, and you could have an anomaly like a derecho type thing. Aside from that, I don't know. There's not going to be a ton of rain here over the next 10 days. Temperatures. I noticed this morning, just a discrepancy in the models. The Euro indicating early this morning that you're going to see like some fairly extreme heat in parts of the Corn Belt in that like 8 to 13 day period. And then the GFS is the exact opposite. Nobody seems concerned about this, but I thought I would point that out.
Yeah, and if the Euro wins, that'll be a reason for them to buy beans for sure.
Could be.
Alrighty, live cattle and feeder cattle prices fell sharply on Thursday. Fund selling, weakening consumer demand, and economic concerns contributed to the declines. The September feeder cattle contract declined by 2.1%, while the October live cattle contract fell by 1.7%. Box beef had another down day yesterday, with the choice cutout falling $2 per hundredweight to $312.79. The downward trend in wholesale beef prices suggests that consumers have had enough of record high retail beef prices. Despite cattle futures declining yesterday, cash cattle prices this week have been mostly steady compared to last week.
Brian, I'm a very simple man. I drew some very simple lines on a very simple chart, but what does this look like to you?
Yeah, so I think the more concerning one is the feeder cattle, and maybe we could toggle back and forth. But when you look at the feeder cattle, one of the things that we've been talking about over the last several weeks when we look at our technicals is just the fact that this feeder cattle market has been kind of trending down since May, where the live cattle market has been trending up. And so you look at the live cattle and where we are relative to back in March, right? So we took out those March highs, where the feeder cattle have been trending down. So feeders haven't even been able to get through that May high. And that divergence between feeder cattle and live cattle is something that we've talked about, and that's been a theme in the cattle market that ultimately led to that large break in the month of March, was that divergence between feeders and live cattle. So the fact that the feeder cattle have rather aggressively broken through that uptrend from the April lows, I think is extremely concerning. And so what I would point out is that when you look at that low during the month of July, that was made around the 10th. The low in the month of June was around the 10th. The low in the month of May was around the 10th. And then low in the month of April was around the 10th. And each of these monthly lows that were higher than the last. Well, look at how we're starting the month of August. We're already breaking down below that July low. We've already traded below the June low. So this is what brings that waterfall effect, where once you go through a monthly low, you're likely to go test the next one. You take that out, then the next one. So I think that's what we're in the period of right now. So what we're looking at here is maybe we can get some bounces back up to that July low, or back up to test these trend lines from underneath. But that is a technical breakdown in the feeder cattle, and I think that will lead to additional selling in live cattle. Now, live cattle, we are still holding that July low. You start taking out the July lows in the live cattle, and that's going to exacerbate the selling. And one of the features we talked about is if the funds that have been in this long-term uptrend, right, that's been 4 years, if they decide that they don't want to be long anymore because of the technical breakdown, whatever their fundamental outlook is, they're probably not just going to get out of longs. They will likely go short. How short they get, maybe it's not that aggressive, but it will lead to a rather sharp move lower here in a quick period of time.
It can happen really quickly in cattle. We've seen that happen before over the years.
Recession fears sent the stock market tumbling on Thursday. The Dow Jones fell 1.2%, the S&P 500 lost 1.4%, and the Nasdaq shed 2.3%. Additionally, the 10-year Treasury yield fell below 4% for the first time since February. Weak economic data was responsible for the declines, raising concerns that the Federal Reserve may have waited too long to cut rates. According to data released on Thursday, jobless claims rose to their highest level in 11 months. Data also showed that U.S. manufacturing activity contracted last month and fell to an 8-month low.
This is the one that sent the stock market lower. The Dow dropped 500 points right when this ISM number came out. And this is data based. It's compiled from monthly replies. It's a survey basically of people on the supply chain, different executives in different industrial companies. Jobless claims are still not high. 249,000 isn't high. We were higher than that back in August of 2023. Stock market looks to be in correction mode, I guess. And that's not totally shocking, I don't think.
No, I mean, a lot of this last leg of the rally was, an awful lot of it was led by the NASDAQ, right? So your tech stocks. And so as we're getting earnings for a lot of these tech companies, Apple, Meta, what have you, if they're disappointing, then that's going to be a weight on the market overall, especially in the sector that's been leading things. I looked at yesterday, and I just kind of was looking at the S&P and the NASDAQ, and I made a 240-minute chart, right? So every bar represents 4 hours of trade. And that bar for yesterday, the type of selling that we saw was one of the tallest bars I've seen. It was just probably the most aggressive 4 hours of selling in the equity market that we've had since the COVID period. So I think that and the type of volume that we saw suggests that we've got some more downside here in equities. And we had made some lows earlier this week and last week in the S&P that were around that 54.30 area. We rifled off of it a couple days ago, and just to come down yesterday, and now we broke down through that overnight. So this looks like the beginning of a little bit of a short-term bear market to me in equities. And then when we relate that back to the cattle market, I don't think that's going to have a positive influence in cattle values.
No, not at all. As Brian mentioned, stocks are getting hammered again early this morning. The S&P is down 60 points. The Dow's down almost 400. U.S. dollar's down a little bit. Gold's up $28. Crude oil is about flat at 76.36 in the September WTI. Brian, thanks for joining us. Guys, have a nice weekend. We'll talk to you on Monday.